Hey guys, Tony here. Polestar Q3 earnings, the good, the bad, and the risky. We're going to talk about all of it in light of the earnings that just dropped last week, and I want to touch on a couple of misconceptions which are being pushed out on social media. Let's dive into Polestar. For about the last 2 years, I've been telling you guys, these tier 2 EV companies, wait on them, be patient. Tier 2 being in production but not yet profitable. And there's a reason why I wanted you to be patient on these companies, because they are going to burn cash until they get to the point where they're cash flow positive. And for many of these companies, that's not going to be till 2026, 2027, if they're lucky, if they make it. And I love Polestar. I love all of these companies. I want all of them to succeed. But we've seen Polestar drop from $16 back in 2021 to its current price of $2.23. So let's have a little talk today based on guidance from management on the November 8th earnings call about what we can expect for Polestar and any potential investment in this company over the next 5 quarters. When we are looking at making an investment in something for long term, it troubles me when I see on social media people pumping out messages like Polestar has no debt or it's a debt-free business, when the reality is very different. And that's why I always encourage you guys to go look at the financial statements, make sure you understand them, and look at that balance sheet. Here is the reality for Polestar. They have almost $3 billion in debt, and it has increased more than 100% in the last 12 months. You have to be careful about what graphs you believe, because if you just look at long-term debt, Polestar looks like it has no debt. That is because all of their debt is on the current debt portion, the short-term debt due in 12 months or less. They are using debt, and a lot of it, to fund the ongoing needs of the business for cash. You can believe what you want to believe. I get my data directly off of the company provided balance sheet, and it's unavoidable that these companies are going to need to have debt. But the thing is, if you put your head in the sand and ignore that debt is out there, or even worse, ignore what they're telling us about their upcoming cash needs, you are going to get blown out of the water thinking that this stock is undervalued right now, because there is likely more dilution coming and more downside for this stock. All right, let's switch gears and talk about some of the good news from Polestar in the last couple of weeks. I do like this company. I love their cars. I hope that they are successful. They've got a dealership here and they sell them here in my hometown. I've been to visit them. And we got a press release from Polestar on November 15th that the Polestar 4 production has started and the first customer deliveries are expected before the end of 2023 in China. And then for the US, those Polestar 4 deliveries will begin in 2024. Let's take a quick look at the product roadmap. You can see on my spreadsheet here up at the top, the key products they have right now is the Polestar 2. They will have 3 vehicles in production in 2024. The Polestar 2, the Polestar 3, and the Polestar 4. With the Polestar 4, as I just said, launching as we speak in China. This is an interesting vehicle concept because it brings a lower price point SUV to their lineup. The Polestar 3 coming mid-2024 will be the full-size, full-featured SUV at a higher price point. As we zoom in on the spreadsheet and look at their manufacturing locations, we got another press release to talk about in the last week or so. We already know that they're building the vehicles in China. We know that Charleston, South Carolina is on tap for 2024 for the Polestar 3. We know that the Polestar 4 also is going to be built in China, but they had another location that they were going to announce. And we got that news last week around November 8th, November 9th. Polestar announced that they will expand their manufacturing footprint to include Busan, South Korea for the Polestar 4. This gives them a great opportunity not only to have manufacturing in South Korea for direct sales into the South Korea market, but for US customers, by producing the vehicles in South Korea, that saves them a 25% import tax for US delivered vehicles versus vehicles that they are producing in China. Once they get Busan up and running in South Korea, that will provide a meaningful price impact to US customers in 2025. One final press release to talk about before we go through a high level of the Q3 earnings and my closing thoughts is this one right here from November 8th. Polestar presents strengthened business plan and funding update. And they're telling us that for the fiscal year 2025, Polestar is targeting a gross margin in the high teens with a total annual volume of approximately 155 to 165,000 cars. Right now, their gross margin, which is the top line revenue minus the cost of that revenue, is positive, but it's only about 0.5%. So they are telling us that by 2025, they want to have that in the high teens. The other thing that they want to talk to us about in this release goes back to what we were just talking about with the debt and cash liquidity. Volvo Cars has extended the maturity of their term loan by over 3 years to June 2027 and provided an aggregate of $200 million in additional loan capacity with the same maturity date. And Geely also is making available a $250 million loan on substantially the same terms as Volvo Cars. The thing that I want you to make sure you don't ignore is what I have highlighted in blue. Both loans have an optional equity conversion feature. So in the back of my mind, and what I want you to be thinking is, if this company becomes successful and the price of the stock goes up, these loans are convertible into common stock. That is something that you need to be aware of. And finally, maybe the most important thing that you need to know that they communicated to us is that Polestar expects that even with this additional liquidity being provided by these two lenders, that they will require external funding, i.e. probably dilution, of approximately $1.3 billion until they achieve cash flow break even, which will be in 2025. So in the back of my mind, I don't care how cheap Polestar gets right now. I know that their financial model forecasts are telling them, and they are telling us, that they're going to need another $1.3 billion. And I would expect that there's going to be some additional dilution in 2024 for Polestar. Looking at the dashboard momentarily, which gives you my own risk analysis for Polestar. If you're a retail investor, is this a safe investment or a risky one? These safer investments will tend to be all green. The riskier ones, where you might have some downward price potential over the next year, are going to have a lot of red and yellow. This kind of financial analysis is how Wall Street and institutions are looking at the company. And when you see a lot of red and yellow on here, you need to pay attention to the financial statements, not just to how pretty the cars look. Profitability, no. Earnings momentum, -7 cents and falling from a year ago, gets them a red box for there. Return on equity is negative, that's a red box. Cash position is weak. It's under 12 months, yellow box. Although they will, I'm sure, be able to raise more cash. That's something we got to worry about on the dilution side. Debt to equity is negative, automatic red box. Current ratio, current assets versus current liabilities, also known as the working capital. A major red flag here being less than 1, and we'll see that on the balance sheet in just a second. Revenue growth rate is good. They get a green box for that one. Dilution risk, I have that one as red. CEO and management, I have that on yellow because they are not meeting the forecasts. They keep on having to reduce their production forecasts, and maybe that's not their fault. The entire market for EVs right now is under some pressure, but for now, since they aren't meeting what they told us 2 years ago, they're going to stay in the yellow category on that. Short interest is green. There's not a high level of short interest from what I can tell on Polestar. And dividends, that one we don't need to worry about. We don't expect them to pay a dividend being a new company. Insider trades is green because I did not find any evidence of massive insider selling of Polestar stock. Now let's close out with the Q3 numbers. Polestar delivered 13,976 units in Q3. That is about a 51% increase from the same quarter a year ago, although it is a decrease from the most recent quarter. Q2, they delivered 15,765. In the earnings call last week, they told us that their guidance for the year, the entire year 2023, would be 60,000 units. They've delivered 41,800. That gives us an estimate for their Q4 deliveries at just over 18,000 units. Top line revenue for the quarter came in at $613 million. That was a 40% increase looking at the same quarter a year ago, although it was slightly down compared to Q2, which came in at $685 million. Polestar ended Q3 with cash and cash equivalents of $951 million. We can see that here on the top of the balance sheet. And while we're on the balance sheet, let's just take a look at the current ratio, or the working capital, one of those red boxes on my dashboard. Total current assets is only $2.4 billion. versus total current liabilities at $4.5 billion. When you see current liabilities higher than current assets, then you have a working capital problem. And the typical way that a company is going to solve that working capital problem would be by issuing more stock, getting more cash on the balance sheet without affecting the debt. The bulk of those current liabilities come from debt. Remember those charts we talked about at the very beginning of this video? The company has $2.9 billion almost in current debt that is due within 12 months, and that is what is driving up the current liabilities. When we look at long-term debt, the misleading chart that some people are putting out there saying this company is debt-free, long-term debt which is due more than 12 months from now, is very low at $74 million. But when you add up that current debt plus the long-term debt, you have total debt approaching $3 billion, $2.97 billion to be exact. When we compare that debt to where they were a year ago in total debt, they had $1.26 billion in debt a year ago. Now that is more than 100% increase in debt in just 12 months. Now, I'm not trying to knock on Polestar. All of these EV startups are going to have to take on debt, and many of them have billions of dollars, but it is something that you can't mislead people about or ignore the fact that this company has significant debt. Two other things at the bottom of the balance sheet that Wall Street is going to be looking at and that directly reflect on my dashboard, the green, yellow, red dashboard, are the shareholders' equity being negative $628 million, and that working capital issue, negative $2 billion in working capital. When we wrap up this first round of videos on all of the tier 2 companies, we're going to do some comparisons, but I just want to key into something here with Polestar. When you compare that working capital and shareholders' equity being negative on a Polestar to something like a Rivian or Lucid, both of them have positive shareholders' equity and a positive working capital. So that is something important to know if you're trying to figure out why is the price of one acting strange relative to the others. Closing out our very high-level look at the financial statements with a quick peek at the cash flow statement, they had negative operating cash flow, $674 million, positive investing cash flow of 91.6, and positive financing cash flow of 481, giving them a net negative cash flow of $106 million for the quarter. I touch on the cash flow because I want to tie it back to this press release we talked about at the beginning of this video, where Polestar is telling us that they don't expect to be cash flow break even until 2025. That is something you need to keep in mind, and the reason why they're going to need to raise additional cash. Like all EV startups, they're going to need a lot of cash. They're going to burn a lot of cash. Polestar in the 9 months so far of 2023 has gone through over $1.3 billion just in operating cash burn. That cash burn is offset by the money they bring in through financing activities, taking on debt. Remember, they do have debt. We can see here $1.5 billion brought in 9 months through short-term debt financing. We don't have any firm production targets for 2024 yet. As soon as we do, I will let you know. It's probably going to be after they announce the Q4 earnings. But let's look at the analyst forecast because, again, depending on how deep you look into these things, sometimes it can be a little bit misleading, right? We see on here that the analyst consensus of 5 stock analysts, it's rated a buy with an average price target of $6.40, a high of $12 and a low of $2. But if we go down further and drill down to the analysts who have actually updated their numbers recently, November 14th, November 1st, September 7th. All of the ones that have done a recent upgrade have dropped their price target. Dan Levy having dropped his from $5 back in September to $2 on November 14th. So let me know, what are you doing with Polestar? Do you own any Polestar? I do not own any Polestar right now. What is your price target? I think there could be some opportunities here for momentum trading if you are very careful. If you are looking at it for a long-term hold, I would urge caution. Let me know your thoughts down below in the comments. I am Tony Denaro, and I will see ya on the next video.